Hello everyone, my name is Tawanda Vera. I'm in Group D with Trevor Mooney and Ravindra Rapaka. We are here to present our project, Dynamic Regime Strategy for Stress Testing and Optimizing Institutional Investor Portfolios. I'll do the rundown of the whole slide, and which captures all the links and the videos that have been made, so that everyone can understand how to navigate the slide. So to start off, this slide is the slide we are seeing now is our main slide, and there's that link, the final project presentation link, and on that link takes you to our Google Drive presentation slide there, where we have put all our videos, we've put in all our links to allow everyone to get an understanding of our project. I'll present the overview of the project. Ravindra presented the tools and methods, and also presented portfolio construction and the LSTM forecasting, while Trevor Mooney will present on the conclusion, and you give us a critical analysis of our strategy in terms of the discussion of what the strategy can do and will achieve. You will also discuss our limitations and future considerations. Thank you. And our project was under the practical track. It was under long-term trading models, handling market regime shifts, and keywords include deep value, momentum, machine learning, risk vector curves, stress testing, risk premia, volatility targeting, multi-asset portfolios, and layered pairs hedge trading, which we are calling pairs of pairs trading, and drawdown control systems, as well as measured features. We have on our Google slide, we've made self-introductory videos for each of us, where we comply with the student verification process, and the links are also on the slide on Google slide. Our project aimed to develop a standalone trading system to construct portfolios that show the benefits of value and momentum style integration, as well as present the effectiveness of alternative integration methods for long-only absolute return funds, which then seeks to get an absolute return that not only is not highly correlated to traditional assets such as stocks and bonds. So that's where the key aspect was. We're trying to come up with an absolute return that is not correlated to equity. So we adopted the portfolio construction framework inspired by the work of Fernandez Perez, Puetes, and Mifres. They looked at a framework for futures, but for them they had a lot of extra data, like term structure and other indicators which we didn't have access to that data. So for us, we had to try to find a way to come up with a model without that data. And our project is located within an alternative risk premium strategies. These ARP strategies use portfolio construction philosophy that is rooted in the principles of consistency, diversification, and downside protection. Specifically, we drew on 3 building blocks. We had a timing portfolio, construction portfolio, and then we then combined them in order to pursue a range of risk and return objectives. Each component of our portfolio was built from bottom up with a specific objective in mind. For instance, we actually generated portfolios with inverse variance, and we also did our main portfolio, which is the hierarchy or risk parity, as part of our allocation styles. Our problem statement reads as follows. We took a quantitative investment strategy approach. So looking at the quantitative investment strategies, our project falls within those 4 general approaches, mainly the alternative risk premium, diversifiers, But the other three are long treasuries, trend following, tail risk hedging. So our project was motivated by what we saw from literature. The 2008 financial crisis clearly showed that diversification is not sufficient to avoid large drawdowns. So there's so many literature on that, which has shown how diversification failed when it was needed the most, because correlations between risky assets tend to strengthen during times of crisis. I think we also saw that during our back testing. Additionally, many investors diversify their portfolios on the basis of capital and not by risk, and this leads to a common problem for retail and institutional investors alike, as their portfolios tend to be highly concentrated in the equity risk and therefore overly susceptible to equity market drawdowns, regardless of their portfolios being seemingly diversified, as witnessed during the 2008 financial crisis. So these challenges have provided a fertile ground for disruptive financial innovations that are significantly affecting the investment in the asset management industry. As such, the development of our strategy was to target a major void in the allocation of institutional investors and portfolios which contain strategies that follow the two extremes. Well, at one end, we've got low cost, lowly differentiated strategies with high capacity, yet contain high amounts of market directional risk. And on the other end, we've got high cost, highly differentiated strategies with low capacity, yet contain no market directional risk. So we were trying to find ourselves within those two extremes. Our research and objectives. Our initial path was set to develop an alternative risk premium strategy, as alluded to in our problem statement, which at a high level focused on delivering value, momentum, and risk balance characteristics. Most importantly, our strategy must trade highly liquid, tradable securities in order to offer a high level of capacity and liquidity to the investors, as compared to many of the most highly differentiated and well-known hedge fund strategies. While the results delivered strongly addressed the original goals that we set out to achieve, the path taken could be categorized as meaningfully different, yet fundamentally similar at the same time. We focused on portfolio construction decisions, and these decisions evolved. They evolved greatly during our development process, with the final results appearing unrelated to our original plan, but the factors underneath the surface, both risk-based and returns-based, remained unchanged. Our biggest contribution was to create value from a futures contract universe, which was very difficult considering the term structures, and we were trying to look at to present them as continuous features. So we needed to show that we understood what was happening with the strategy, so that when we later apply these advanced algorithms like the genetic or reinforced learning or the LSTM that we used, we could actually defend our work in terms of it being a risk premium. So we meticulously reviewed academic literature to support any risk premium style that would form part of our portfolio. So we came up with sort of guidelines that would lead us so that we don't get astray. We understood that our project was too big for the time given, so we focused on trying to have guidelines to say, okay, if we achieve this, we can move to the next stage. So the first part was we wanted to achieve was to get a consistent profitability. So we're looking for strategies that generate consistent positive returns. The higher, the sharper, the better. And on the we also wanted to look at a strategy that trades actively. So we evaluate trading opportunities. Our strategy evaluates trading opportunities frequently, preferably every day. We had tried monthly, but our data did not allow us. So we went back to to daily. We're also looking for strategies that place many independent bets. So we're using meta labeling to get the trades. So an independent bet is a bet that either takes a new position or reverses your direction, long or short, in an existing position. So we found an interesting study on wavelets, a study on the relationship between financial stress and US equity. And from that study, they used MODWIT, the maximum overlap discrete wavelength transformation. So from there, we came up with our profit taking cutoff. Is guided by the wavelengths, and we also came up with our stop loss cutoff and our minimum returns. So our profit taking cutoff was 2.5%, and our stop loss was 1.5%, and our target to have minimum returns of at least 2.5%. The 2.5% was used to create a triple barrier labeling and meta labeling. However, platinum futures and feeder cutoff futures were not able to be processed as they were not giving us the 2.5% that we were looking for. Our strategy allocation criteria also focused on controlling the risk. So the expected shortfall is a good approximation for the risk associated with the particular futures portfolio. So we're looking for strategies that do not exceed an expected shortfall of 1.5% of the portfolio value, as alluded to before. A strategy that have low exposure to the stocks and bonds, in line with our original objective. A strategy that is low directional exposure to any particular underlying. This is the same idea as position concentration, where we are looking for strategies that are not vulnerable to big price movements in any single asset. So here we relied mainly on, that's why you find we focused on pairs, and on top of the pairs we did another pairs of the pairs. So in coming up with our pairs of pairs strategy, we relied on Chad Fulton's business cycle coincidence index. So we played around with the code to try to see how the pairs would react, how the trends were moving in terms of looking at in times of stress, like the financial crisis, in line with what Chad Fulton was doing with his original business cycle code. So we ran a few, and it gave us ideas on how to tweak our code. So with futures, we are looking for algorithms that are not overexposed to any particular underlying or single contract, as I mentioned before. One way to lower this type of risk is to diversify across many instruments and trade many futures in different sectors. Now, when we're trading our futures, the trick there was to make sure that the futures that we are trading have got a similar term structure, and that is the futures that we are pairing on the first pairing were from the same sector. So what we did was we ran our returns, and we sorted the asset or commodity with the highest returns was then used to pair with the others within that sector. Another way was also to offset contracts on the same chain in such a way that our net risk exposure is close to zero. So in this case, we couldn't get our term structures. So our pair strategies, these strategies, they helped us capitalize on the economic upstream and downstream relationships through the spread ratio. So we then developed our portfolio based on the pairs of pairs, and our portfolio construction was guided by the crisp DM approach. So for our project, we followed the cross-industry standard process for data mining approach, which is the crisp DM. which entails data collection, and it's a continuous process for development of your project. As you can see from the diagram there, we collected our raw data into a data store, and we developed our pairs, and we did our back testing, and we looped the process until we came up with the final product. For more details, Ravindra will look at it, will give us the rundown on portfolio construction and LSTM forecasting and the challenges that we faced. And for our data sources, we used Quando and investment.com, and we had 23 commodity futures divided into 5 related subsectors and 5 currency exchange pairs, which were all against the US dollar, and 4 commodity indices. Most of the data is clean, except for some missing numbers and formatting issues. The backtesting steps outlined there. We had 54 pairs from our combinations. Appendix A details. There's more details on that. Appendix A is in our report. And the hierarchy risk parity, Trevor will look into that. As the video there that has been attached is discussed and is given us an analysis of our strategy, and has come up and given us the conclusions. He also went through and gave a commentary on the limitations of the project and future considerations. The link is on our drive. Ravindra also gave us a rundown of the tools and methods where we used the GitHub repo. And I did the Slack workspace. Thank you.